professional concerned about market risk and the volatility that's going on in the market right now. Today, we're going to talk about risk tolerance. So you're going to want to stay tuned until the end because I've got a valuable free resource for you that's going to help you figure out if your risk tolerance is in alignment with what your investments are doing. Today, we're talking about risk tolerance. So maybe you haven't thought of it this way, but investing is like practicing medicine. You wouldn't prescribe medicine or treatment without first diagnosing the patient. So similarly, jumping into investments without understanding your risk tolerance is like gambling with your financial future. So without the right diagnosis, you could end up with unnecessary stress, sleepless nights, even worse, substantial losses. So this is where financial triage comes in. Just like medical triage sorts out our priorities in an emergency room, financial triage evaluates your risk tolerance before crafting a sound investment strategy. So the goal is to find the right balance between growing your wealth and maintaining your peace of mind. So in this episode, we're going to break down how to assess your risk tolerance, explain the categories of low, medium, and high risk investments, and figure out where you stand depending on how close you are to retirement. So we'll also explore why saving more often beats chasing returns and how balancing your portfolio can help you avoid unnecessary stress. So today's objective is to help you assess your risk tolerance so that you can balance your investments. So what is risk tolerance? Well, risk tolerance is your ability to handle the ups and downs of the market. Remember, it can feel like a roller coaster without feeling overly anxious or stressed. It's a balance between the desire for returns and your comfort level with potential losses. So just like pain tolerance, this varies from person to person. Each of your clients feels pain differently, and so risk tolerance does too. Some investors can handle the market swings. Others prefer a more stable ride. So if your stomach churns every time the stock market dips, you likely have a lower risk tolerance. And conversely, if you're okay with short-term losses or long-term gains, you might have a higher risk tolerance. So understanding your emotional reaction to the market fluctuations is key to developing the right strategy for you. So let's face it, you work hard for your money, and it's even harder to save money now. So when you don't know where you're at, you could be setting yourself up for more stress than you want. If you see your savings being lost, remember, just because the market is positive doesn't mean your stock choices are positive. And so what I mean by that is you may see something like, here's what the S&P is doing. Okay, that's the S&P, which is 500 stocks, but yet you've chosen a stock that is not doing as well as what the S&P is. So just a little clarification there. Okay, so let's talk about some categories of investment risk. So investments come with varying degrees of risk, and your risk tolerance will determine what types of investments are suitable for you. So let's break them down into three categories: low, medium, and high risk investments. So our low risk investments, they're like financial band-aids. They offer stable returns with little volatility, making them a safe bet for cautious investors or those nearing retirement. So some examples of these, if we look here on this triangle on the page, we've got government bonds. So these are backed by the government, so the risk is minimal. You're not going to make a fortune, but you're not going to lose your shirt either. So savings accounts or CDs, certificates of deposit, while the returns are modest, your money is safe. And then we've got blue chip stocks. So blue chip stocks are large, established companies with consistent dividends, offer a stable, albeit slower growth rate. Okay. So low risk investments are perfect for investors with low risk tolerance or those in the final stretch before retirement. The goal here is capital preservation, not aggressive growth. And why I say before retirement is because guess what? When you're getting closer to retirement, you don't have all the years to make up any losses that you may have had. Okay. So next is medium risk investments, those that offer a balanced approach between safety and potential growth. So they're a good choice if you can handle some market fluctuations without losing sleep, but you don't want to take on too much risk. So some examples of medium risk investments include index funds or ETFs. So these funds spread your investment across multiple assets, providing diversification and minimizing volatility. The key point here is it's more than one stock, right? So if we say the S&P 500, that's more than one stock. It's 500 stocks. So you're not going to lose as much because it's not one particular stock, okay? It's following and diversifying. Corporate bonds, so while they're riskier than government bonds, they offer higher returns and are less volatile than stocks. So then we've got balanced mutual funds. So these funds mix stocks and bonds, giving you a blend of growth and stability. And these investments are ideal if you've still got some time before retirement, but want to start dialing down the risk as you get closer to your goal. And what I would say about mutual funds is to do your homework here. fees can vary a lot. Just because you're in a plan at work doesn't mean that there's not fees involved, okay? So you want to check out the fees. Also check out how quickly that you can exit. So if you started seeing the market going down and you wanted to get out of that mutual fund, how long is it going to take you to get out of it? Okay, these are important. So fees and what does it take to get out of the fund? All right, next we've got high risk investments. So these are an adrenaline rush in the financial world. And I know a lot of doctors that I've talked to, man, they like this. They feel like they're behind. They feel like they spent so much time in school and paying back student loans and everything else that they're looking for those high returns. Okay, so they offer the potential for high returns, but they come with significant volatility. So these are for investors with a high tolerance for risk and a long timeline to recover from potential losses. Okay, so examples on the high risk is one, individual stocks. So picking specific stocks can yield high returns, but they're also susceptible to major loss. Remember, you've put all your eggs in one basket on one stock versus on a bucket like an index fund or even a mutual fund. Okay, cryptocurrencies, these are known for their volatility. Cryptocurrencies can generate massive gains or losses overnight. All right, the key word there is volatility. So we talk about low, medium, and high risk investments. We're talking about the roller coaster. So we talk about individual stocks, we talk about cryptocurrencies, and next I'll talk about venture capital investments. They may come with some big highs, but they also may come with some big lows. Okay, so venture capital investments, this is investing in startups that can result in massive rewards if the company takes off, but there's also a high chance of failure. Okay, so high risk investments are suitable for younger investors or those willing to ride out market ups and downs for long-term growth. So I want to say one thing here. I understand that you may feel like you're behind, but just because you're behind doesn't mean you should be taking on high risk, okay? So please be careful, and feeling behind is not as bad as losing your hard-earned savings because you're taking high risks. So I'm going to show you a quick slide that may change your mind about how you look at this. Okay, so you may not know this, but it isn't about the returns that you get. It is about how much you save. So what this chart shows when you look at it is that your retirement money is really based 74% on the amount that you save, meaning the money that's working for you, and only 24% is based on the rate of return. So let's sit on that for just a second. Does that make sense? So we're chasing these returns to try and get huge, huge returns. And I'm going to show you why in a minute that that's not working for us. Okay. But keep this in mind. If the one thing that you take away today is this point, that 74% of the money that you're going to have is based on what you save and only 24% is based on the returns, then that can change your world as far as getting ready for retirement. Okay. So we spend a crazy amount of time chasing our returns, don't we? We're looking for the best stock, the best investment, etc. And now she shows us this. And yes, I also wish I'd known this when I was 20 years old. So, you know, if you know a 20-year-old or you've got kids or whatever, you might show them this slide, because as we pick it up, you know, I saw this slide, I think, for the first time in my late 40s, and I was like, holy cow, I wish I'd known it 20 years ago. So, well, now you know it. And my question for you is, what are you going to do with this new information? So now let me show you a key reason of why this is true. Okay. And there's a source down here. I think it's Retirement Success is the source that came from, but I've seen it in multiple places. It's always in the 70s versus the 20s. Okay. So this is the history of the stock market since 1926. I know there's a lot on that slide. And what I really want you to notice is the blue blocks and the orange blocks next to them. So the blue blocks is a bull market. Bull market means the market's going up. It's going up, up, up. Everybody loves a bull market. And a bear market is when the market is going down. Okay. So to simplify this, blue is bull, orange is bear. And if you look at this, it looks a little bit like a roller coaster. Okay. So we like the big blue spikes, but we really don't like the orange spikes down. So those orange spikes, just to give you an average idea, over time, all of those, the orange spikes, it's a short period of time, average is 1.4 years on a bear market, okay? But the average that it produced is negative 41% on your portfolio or your 401k. So let's think about that. Let's say you had $1 million, just for easy math. So what we're saying is the average, every time that there's a bear market, your $1 million would go to $600,000. That's 40%. Okay. So this is why how much you save is more important than the market returns, because in the market returns, as we've got it in there, and they always say invest for a long period of time. But you know what? We've got all of that buyer behavior that we freak out when the market drops. We get out, we sit on the sidelines, we miss some of the upside. I can do an entire presentation just on that. And we all do it. I've done it, and I'm sure a lot of you have. But you've got to understand that what goes up will come down. And for the long term, yeah. But the reality is 99.9% of the population is not in it for the long term, and our buyer behavior gets in the way. So what I specialize in is eliminating those negative market returns and creating tax advantaged income for retirement. So imagine if you looked at this chart and there was no orange spikes going down. Okay. Now imagine if it was set up correctly, that we optimize that, and now we've even eliminated taxes on your retirement income. So this isn't something that you can do yourselves. This is what I do as an expert in this area. Okay, so risk tolerance, financial triage, adjusting your strategy like treatment. Okay, so your risk tolerance and your retirement timeline. So your risk tolerance should adjust as you move closer to retirement. The closer you're getting to retirement shouldn't be those high risk years. Okay, so think of your retirement timeline as the guiding heartbeat. It's the guiding heartbeat of your investment strategy. The closer you get, the more stable your portfolio should be. Okay, so 20 years from retirement, if you're still in your 20s or 30s, time's on your side. You can afford to take more risks because you have decades to recover from any downturns, and high risk investments like individual stocks or cryptocurrencies may be suitable for you as you're seeking, long-term growth. Now, one thing I would also say about our 20s, if it was anything like my 20s, is that I didn't have as much to invest. Not only did I not have as much to invest, I also didn't have a pile of money that I was putting at risk. Okay. So what I would say for everybody that's on the call is that there's not one choice. You're not picking one stock. You're not picking one cryptocurrency. You're not picking one ETF. It's the diversification of that package, right? And so the stuff that I do outside of so much of the stock market is one more piece on the diversification. I want to make sure that your baseline is covered. Your baseline meaning the lights are on, you're paying for your house, all the things that you need on a monthly basis, so that you've got a piece that if you want to invest crazy on that, or you've got somebody that's got a deal or whatever, that's fine, but it's not going to risk your future lifestyle to do that. Okay. So also 10 to 20 years from retirement is, let's say you're in your 40s and 50s. It's time to start balancing your portfolio. While you still want growth, you also want to reduce your exposure to major losses. And medium risk investments such as index funds, corporate bonds become more attractive. And if you're less than 10 years from retirement, okay, as you approach that retirement, it's time to get conservative. So low risk investments like government bonds, blue chip stocks help preserve the wealth you've built over the years. So the focus should be on protecting your savings and ensuring it's there when you need it. And when I talk about this, you may have pretty much all your investment money in a 401k through work. Okay, you may have some IRAs, things like that. But keep in mind that as you do that and as you look at that, you're looking at that high, medium, and low within that portfolio. Okay. And hopefully if you've got something through your company or your hospital, the investment people that are working with that plan can help you. Okay. So I would look at that and say, okay, I'm 5 years out from retirement, or I'm 10 years out from retirement. What should it look like? And so there's even funds out there that are saying, okay, my retirement is in this year. This is what they're recommending. And I'd pay attention to that, right? It's not always perfect, but it's usually better than just winging it. Okay. So pay attention to what they've got for you there. So my question for you is, are you ready to take control of your financial future? So understanding your risk tolerance, what we talked about today is the foundation of a sound financial plan, just like a sound treatment plan. It's about finding the right balance between taking risks and ensuring that your long-term goals stay on track. But without a clear vision for your financial future, even the best laid investment plans can fall short. Okay, so that's why today I'm giving you a free risk assessment tool. It's a short questionnaire that's going to take you 5 to 10 minutes to complete to understand your own risk tolerance level. Once you've done that, the exercise can then be compared to how you're saving and investing. And you might be surprised with the results, and it may explain why you feel the way that you do when an investment of the market is not performing the way that you thought it was going to. So take advantage of this freebie by scanning the QR code or going to www.muellerassetstrategies.com/risk-PDF. Feel free to share this with anyone you want. You could even share the completed document with your advisor and ask them, are my investments in alignment with my risk tolerance? And see what they say. Our goal is to feel like our results are closer to what we want, and we're comfortable with. So again, scan the QR code and we'll see you next week.